Good evening. Yeah, this is the 16th of March, Monday night. So the reason I'm making a big deal out of the date is because things are changing fast. We all know about the whole coronavirus and everything that's changing, and some of the anyway, we're just in uncharted territory, is what I'm trying to say. So first off, hopefully everybody's doing well, but second off, this course will continue as normal. Obviously, it's distance education, and obviously, the more you can stay to a normal life, the better you're going to be, and the more you'll be prepared in case things do get worse. Obviously, the weather's cooperating. It's absolutely beautiful out today. So, and you can do that without risking anything. And I guess the kids are out of school, and you may or may not be working, but even so, the nights are getting long enough to where you still have sunlight after work. So anyway, I encourage you to you know whatever. It's more productive than hoarding friggin' toilet paper. Um, I'm going to talk about the exam tonight. I'm also going to look at a few things. I'm not trying to be ghoulish here, but there are some things to be learned from a personal finance perspective from this whole situation we're in. All these people who say, "Oh yeah, yeah," I own some Bitcoin. Full disclosure here, I've got one. I used to have two, but anyway, I bought them for like $700, so I'm still up a bit, but I was up like double this about a week ago. So, oh yeah, Bitcoin, it's a great hedge. Yeah, not so much. And the same could be said for gold here. This is price per kilogram, so the units aren't all that important. US dollar 16, and now it's way down here. I mean, it's dropped a bit. It certainly didn't go up. I mean, yeah, it's not down by 30%, but it's not where you'd want to be. Real estate's more of a long-term thing. It probably at some point things are going to go back to normal. And especially for the demographic of this class, most of you all, in fact, even up to my age, we're probably going to be less impacted, but it could get horrific if we get in some Italy scenario. But let's not dwell on that. And mortgage rates. So I did actually have a student, I'm not just throwing this out there, but a student asked a good question about refinancing, possibly on a mortgage, because interest rates are down to zero now. So what the money supply people do, so the Fed here or other organizations, on a global scale, they try to do what they can to reduce the price of borrowing. In fact, what they really want to do is they kind of want to discourage saving. They want to get the economy stimulated, worldwide. So they want to, like I say, but I'm old enough to have been at a point where I can make 8% way back when on a savings account. Well, that doesn't happen anymore. And in fact, right now, the down to zero for a short-term savings type thing, or a Fed, where one bank's the prime rate, where one bank is loaning to another, so it's virtually, zero risk that somebody's going to fault on that. You can't go to a bank right now and get a zero interest rate loan because, they've got to play the averages. They've got to play the averages that, well, number one, they're in business to kind of make money, so they don't want to loan money at zero. And then also, there's a certain percentage that they have to charge a bit of interest for, because not everybody's going to pay back the loan. Some people kind of flake out, and so obviously, prime rate is going to be the lowest rate, and then any other rate depending on your collateral, what you put up against that loan, or what your financial situation is, that is interpreted by the bank of the risk of you not paying it back, is going to be. But you can see that mortgage rates, we're talking 30-year mortgages. That's a long time. You know, this whole situation we're in is going to play itself out, hopefully, in a short period, but, even worst case, we're talking, you know, well, whatever. I don't want to speculate, but we're hoping months, weeks, not 30 years. So the rates are lower, yes, but half a percent. So the basic rule of thumb, and don't go by, some buffoon, whatever, if, teachers who, whatever, if people who could, I'm not saying I'm not credible in terms of my business acumen, but obviously I've got a friend who I talk to who's in the mortgage business that I speak to when I want advice whether to refinance or not because he does it every single day. But I think the advice he would give you is that this is not that big a drop. 3.36, compared to Bitcoin losing 50%, stock market down, what, 30%, and this down by half a percent. Um, well, it's bigger than that, obviously, from 3.72 to 3.36 is about half a percent, but of the total loss is a little more. But anyway, I'm not going to split hairs here. But the general rule of thumb is if you were somebody who had a 4.4, 6, usually a percent is kind of the rule of thumb they go by. If you've got a 5% mortgage or something, yeah, you want to be calling somebody and saying, "Hey, I'm thinking about refinancing." If you've got a 3.48 mortgage, yeah, your payment would go down just a tad, but the costs and the hassle and well, the hassle is translated into cost, so it wouldn't make financial sense generally to refinance. But again, I'm not a mortgage broker. There's plenty of people out there. Those guys are, they've got your sort of best interest at heart in terms of they want you, well, best interest. We're talking about commission people as well, but in this time your sentiment and their sentiment kind of aligns that they want to sell you a new loan. But if somebody says to refinance when you have like a 3.5%, you better scrutinize the math pretty drastically because you're going to probably find that with all of the charges and everything else, your monthly payment is probably not going to drop appreciably, and you're going to be paying all these new loan origination fees and all this other stuff that had you had an honest guy like I've got, and they're out there, um, they would have said, no, it doesn't make sense right now. But these are low interest rates. Now, if you're somebody who's, whatever, I mean, I want to, let's say you're skillful, but actually you're probably lucky to see this whole drop coming. Yeah, this might be the time to buy or refinance or whatever. But anyway, this whole thing hasn't played out either, and hence, the reason I talked about the date beforehand because I don't know. There's an expression in investments, and we're going to start in investments next week. We're really going to concentrate on the exam review today. But when we talk about investments, there's a concept called market timing, and that's trying to guess when the stock market's going to rise or fall and all that. And it just doesn't work for the most part. Most people can never guess it. And in a situation like this, where a market's in decline and people are just trying to figure out when to buy, they call that catching a falling knife, which again, imagine that in your kitchen, knives falling off the table, a sharp one, not a butter knife, but a real knife, and you're going to try and catch that. It's really hard to figure out when things are rock bottom. Um, anyway, good luck with that. So getting to the exam, and again, I'm trying to make this more productive. These are, more long-lasting kind of lessons, opportunity cost. So, yeah, if you're out, shopping for toilet paper this week, you could have probably spent your time maybe getting food, maybe getting something that would be useful. I don't know. Anybody who's obsessed with that is, I just don't think they're that resourceful. I think there's a lot of better things you could be doing with your time. The supply chain will hopefully stabilize here pretty quick. But anyway, I think most people will work through this situation. But opportunity cost applies to everything. If you're out, well, you're not out drinking at a bar this week, but if you were, as opposed to going to the gym, that's an opportunity cost. And in finance, it's even more more of a factor. If you're smoking, $200 of cigarettes a month, that's not going into financing, your retirement or going into your emergency fund, which might have been useful this week. That's something to think about. So when I go through this test review, I'm not trying to beat people up, but what I am trying to do is go through the exam again because I'm not on commission. The more students who fail, I get absolutely no extra money. So if you think that you know any one of these questions you could argue for a better answer or argue for if you say, well, the answer I put forward was kind of ambiguous, I applaud that and send me an email. Um, at least one or two students have already done that, and I'm usually, if you can make the case, I like that number one because it means that you're, really thinking about the stuff, and a lot of times I might even improve the question for next time, but it does not pain me at all to return the points to you and for you to get a better score. I'm not going to argue over most cases if you can make a case for why you think you got the right answer in spite of the given book answer. So another one on opportunity cost, giving up a movie in order to study for your finance. So opportunity costs, I mean, everybody has seen this in life. If you're doing one thing, you could have been doing another. If you're spending on money on one thing, that's money you don't have available for the other. So, uh, retirement planning, and again, retirement planning is important, but the good thing about retirement planning is when you have a nest egg established, that's something that you could draw against also for your um, short-term uses. There are some hardship type withdrawals with some sort of the tax sheltered retirement plans, but the hardships are not necessarily that hard. There's buying or borrowing money, or taking money out for your first time home purchase. And again, I'll go through the specifics of that, but that's considered a legitimate use. So you put the money in a tax deferred status, and here you're able to pull it out without penalty if it meets with one of the IRS hardship type things. And others are truly hardships, medical situations. So retirement, is where your money is pooled. That's what it's going to ultimately be for, unless, life interrupts and comes up with some more compelling use for it. If spending exceeds the amount, yeah, over a period of time, best option. You have to be able to live within your means. You can do some of these things, a second job and work more hours, but you need to cut back. You need to figure it out and be able to live within your means, which means reducing your spending. Liquid assets. So, um, stock held in a retirement account, yeah, that's going to be difficult in most cases. A lot of times you can take a loan against it, but right now, in essence, when you pull money out of an IRA, you're going to be selling those shares and you'll be reinvesting them. It's a great way to get a loan, but in a market like today where we lost 3,000 points, um, I would I would look for a lot of alternatives before I'd be trying to pull things out of a retirement account. And if you pull them out without a one of those hardship requirements, there's going to be a 10% penalty right off the top. Real estate, real estate is not liquid. Um, Anybody can tube a real estate transaction. It can be the day before the closing, and all of a sudden the buyer can say, "Yeah, I didn't know about such and such." So they just get cold feet. They come up with an excuse, and you're done. Cash in a savings account or cash in a brokerage account. that's not in a retirement, characterized as a retirement, and it's maybe held by a brokerage account, but it's not actually in a stock. It could be in a stock, but again, the stock part wouldn't necessarily speak to the liquidity, but the fact that it's in some sort of equity, a particular company, may influence, the wisdom of selling it. It would anyway. We could argue if there was stock in a savings account and stock and cash in a savings account, those would both be liquid. But um, anyway, I'm making too much on that. But if you had a problem with that question, let me know. Cash is king, though. Cash is the ultimate in liquidity if it's in a savings or a brokerage or anything else. Student loans and housing loans are good examples of long term. So this isn't difficult here. Long term is over a year. Short term is less than a year. All right. So when we talk about somebody's net worth, that is the best measure of a person's family wealth. So, I've given you an example. Somebody owns $1 million car, $1 million home. If there's a loan on it, that's not an asset. The only part of that that would be an asset is the amount of equity that they have actually paid for. So if they've, you know, put say 20% down on their $1 million home and they just bought it, they've got 200,000 of equity, right? The 20% of that $1 million. So and then they've got a $800,000 liability. So um, I'm not saying not to take out loans, but don't measure somebody's wealth in that manner. The amount you earn annually, uh, yeah, it doesn't really work like that. It seems like the more money you make, the more money you spend, and there's lots of people who are, almost living paycheck to paycheck that have a pretty good salary. Total value of investment assets, which is good that those are assets, but it says nothing to the liability. So do they owe a whole bunch of money for other things? And the market value of real estate, again, it doesn't say anything about whether there's loans on all of that. So anyway, to come up with somebody's net worth, you get the assets, you subtract the liabilities, and that's your net worth. That difference between the two. All right. So why is it important to monitor your debt level so it does not become so high that you can't cover the monthly payments? So again, it's quite easy. People will give you loans, and that's why I'm not that worried necessarily about my credit score. My feeling and experience, I think, has kind of shown that you can get yourself into more trouble with credit than consumer credit. If you're buying primarily vehicles and toys and things like that that will get you to a point where maybe a number of small debts or credit card debts just start to add up, and now you've got a problem, and you can't cover your monthly payments. So liquidity ratios, no, that's just an arbitrary number. I mean, it's good to have, but it's in order to qualify for credit, no, don't do that. And total debt does not exceed your annual income. That Well, total debt, no, I can do that in a heartbeat with a mortgage loan. So that's not really that critical. In fact, if you're buying a home, not many people want to live in a 80 or 100 or $120,000 home. So that's kind of a throwaway. Um, Money received today is worth more than money in the future. So that's because of the miracle of compound interest. So future inflation will devalue current investments if you're holding it strictly in cash. I mean, again, you want some cash to get you through a crisis, but most of your other money you want working for you. All goods and services will cost more in the future. It's probably true, but it doesn't really speak to the compound uh, interest, and then unique investments opportunities, which may or not, who knows? Anyway, doesn't address the question. The time value of money implies a dollar today is worth more than a dollar received tomorrow. So yeah, the quicker you can get the money and get it working for you. Um, you'll see this, in a lot of these lottery things. If you'll take a series of payments out in the future, which might actually work for some of those people, that has to do with psychological reasons where people will tend to blow it. But if you're disciplined, if you had the option of getting $1 million today or $1 million a year from now, if you got the $1 million today, you could invest that and do a little bit better. Although zero interest rates are kind of throwing everything aside, but that's a definitely a temporary situation to spur the economy. The earning of interest on interest is called compounding. So if you know nothing about compound interest, yeah, this would be a little bit painful. But guess what? If you know nothing about compounding, life is going to be a little bit painful. Credit cards are going to be very painful. It can work for you or work against you. If you understand compound interest and you invest your money properly, it's going to be your friend. If you don't understand compound interest, and you try and carry credit card debt, you'll learn that lesson, but it's just going to be too late in life, and it's going to be a regret for you. To qualify as head of household, so we're jumping into taxes. Remember, if you're single, that's one issue, but that's not the category you want to be in. That's going to have the highest tax rate. Married is a better, you know, more advantageous rate, but you can't fake that one. But if you're single but you have a dependent, that's the next best option. So that's what it has to do with both A and B, single and have a dependent. And again, the way people end up in this situation a lot of times is through some sort of divorce or something else. So make sure if you're claiming head of household because you're saying that B part that you have a dependent, make sure that your ex is not also claiming that dependent because that will, easily auditable by the IRS and they'll come after you for that. Here's a basic, this is how we buy stock. She purchases stock over 7 years ago, so that's obviously greater than a year, so it's going to be long term. She bought it for 20 grand, she sold it for 35, so she made 15,000 and long term. So A, okay. Purchasing which of the following will help reduce your tax bill? So consumer interest, so credit cards, auto loans, you know, those other categories are not tax deductible. The only interest that's tax deductible up there, and pretty much the only interest that's tax deductible in general, is for your home. So that's there. If you've got rental property, that's a whole different thing. You would be deducting it, but not under your personal thing. You'd be, deducting that as a business expense. So anyway, financial institutions, that's how they make money. You know, they pay you a certain lower rate, and then they um, rent out your money basically at a higher rate, and that spread is where they make the money. Your ability to cover short-term cash deficiencies is liquidity. So solvency, that's just, that's more of a net worth kind of thing, where you have more than you owe. Wealth, that's kind of it's a useful term, but a bit nebulous here. But the short-term deficiencies is addressed by liquidity. Cash planning, if somebody wants to argue that if they chose that, we can talk about that. But really, what the best answer out there is liquidity. And liquidity means being able to, you got an emergency, you need $1,000 tomorrow, that liquidity speaks to that. You can be wealthy, you could have multiple homes, but again, trying to get that $1,000 tomorrow out of that is not going to be easy. Disadvantage of using credit as a source of liquidity is the potential cost of finance charges. So let's say your plan is to have a small amount of cash and roll it onto a credit card. Um, Not a bad strategy as long as you can um, come up with that cash before the finance charges start accruing. So if you can get it within that grace period, that's why it said potential finance charges. A lot of times, if you have an emergency, um, a credit card is actually kind of an ideal way to take care of it in the short run, and then that buys you, basically the 30 days or whatever before you have to start paying interest on it. And if you can pay off that credit card before the end of the statement, then you essentially use that money for free, which is a good thing. Now, I'm not saying to take a cash advance on a credit card. That's a whole different thing. They usually charge you uh, upfront a specific fee, and then they start accruing interest from the day you pull it out of there. So, this only works when say maybe it's an emergency room or somebody else will accept a credit card for payment. But if they actually want cash and you're going to use your credit card like an ATM, they appear to work that way, but financially they absolutely do not. You will get clobbered. Stopping payment on a check. Only if a check is not cleared. So I think I mentioned this in the lecture, the fact that this used to be a big deal where you'd stop payment because it took days for a check to clear. Now that things clear electronically, stopping payment on a check is not as useful. And also, it has to be for a legitimate reason. If you give somebody a check and then you stop payment on it, that's essentially fraud on your part. So definitely make sure you're in the right before you exercise that option. Overdraft protection, an excellent thing to have. Sometimes may require you having a credit card, but again, this might be the credit card, especially if you're not good with those, just to put it in a drawer and don't use it. But having that overdraft protection is huge, as most of us will, theoretically bounce a check at some point in our life. But if you had overdraft protection, it doesn't actually bounce. It just rolls onto the credit card. You pay the balance and everything's fine. All the following situations are valid reasons to borrow money except for living expenses. That's going to catch up with you. If you're, again, we're in different times right now, temporary situation. But if, a month ago you were borrowing money for day-to-day living expenses, that's not good. For the current time, you kind of got to do what you got to do and make sure you stay apprised of whatever sort of benefits maybe come down the road to kind of help people out in the situation. Using a credit card frequently is wise to pay off the balance every month. So again, a convenience user. If you're just making minimum payments to conserve cash, you're not conserving anything. You're going to get hammered with those monthly interest rates. What you're following is not true regarding crash, so I kind of treat it like this. They are not like other charges on the credit card. There is a fee. I know this because there's been, I've had fraud done against me. They stole one of those little convenience checks, kind of looks like a check. Usually I just tear them up. But anyway, in this case, somebody got to the mailbox, took one of those checks, wrote it for like $300. And the first thing I knew was that it was a $10 or $20 fee for using the convenience check. And then, the bank was intending to start charging me interest on that. And when I reported the fraud, all that got rolled back, but I reported it in a timely manner. If I would have let it go a month or so, I would have been, out of luck. Which of the following is true about credit cards like Visa and MasterCard, yeah, can be an excellent source of emergency funds and unexpected. But again, you got to have it doesn't mean that you can do this in lieu of an emergency fund. It just means that it might buy you a little bit of time, a little less liquidity in your emergency fund. You might have it in a brokerage account that might take a week or so to get a check out of or something like that, which is probably smart because it provides you a little bit of protection from identity theft. There's a little less likelihood of identity thieves um, being able to tap into some sort of brokerage account versus your checking account where that checking account number is kind of all over the place in terms of on the internet and the rest of it. Finance charges apply only to balances that were not paid in full, and that's true. So just pay off that balance every month and you're good. APR, annual percentage rate, and that's the number that is universally used. Credit card statement online, you definitely need to do that. Again, people are very friendly, and you will be, fully reimbursed for any bogus charges and the rest of that, as long as you do it quickly. You let it go over a month, or perhaps you wait for the paper statement, and it's just going to be harder. Uh, collateral is a great thing. It is what allows you to get loans for a cheaper interest rate, right? Because the lender, they're just not loaning you money on, your personality or good looks or whatever they call that, a signature loan. It's not just based upon your signature, it's based upon an underlying asset, typically a car, a house, or whatever. And some collateral is better than others. Obviously, a house is great. You can't move it. It's very formalized, so the interest rates on homes are quite low. Cars, the repossession laws are pretty strong. They can come take that thing if you don't pay for it, so they can offer you a lower rate. I mean, you want a collateralized loan because you want that lender to be comfortable, because if they're not comfortable, they're going to just charge you a higher interest rate. What kind of loan generally charges a lower interest rate? A secured loan. So security and collateral, kind of same there. Unsecured loan is like a signature loan, a credit card, something like that, where it's not tied to any one asset. Um, anyway, cosigner typically don't do this, given all kinds of options. What's going to happen here is if you go to a place and you're trying to get a loan, your credit's no good, they're going to say, well, you're going to need a cosigner. So being the person with good credit, says, okay, yeah, you're my friend, I'll cosign with you. Now you're responsible for that loan. And this person who needed to come to you, your friend, from the debt collector, the bill collector, the dog the bounty hunter guy, he's not even going to mess with that person. He's going to come straight to you because you had good credit. So either buy it under your own name or loan the person some money or do whatever, but you are on the hook for the whole loan. And you're probably, by the time you figure out that this person hasn't been paying the loan, it's probably gonna be late in the process, and that's gonna be bad. When you're purchasing a home, why would you not use a real estate commission? Because the seller has to pay for it, right? So that's a good idea. Disadvantage of neighborhood HOA. HOAs can be good, they can be bad. Homeowner association, but yes, it can get way beyond things that you think are reasonable. The numbers of trees, the color of the home, all kinds of stuff. On the other hand, it might prevent, your neighbor from basically running a junkyard out of his house. So it's a two-edged sword. Um, the only answer I've ever come up with is to get more property to where whatever the neighbor does, he's far enough away from me not to bother me. But if you're in a subdivision, Yeah, that's a decision you'll have to make, but it can work for you or certainly against you. So fixed mortgage rate is typically what you want to get. Is when interest rates are low, the necessity to get like an adjustable rate mortgage or something like that. What an adjustable rate mortgage would do is you'd be able to have a lower payment, but right now, with interest rates being so low, you'd probably want to get a fixed rate mortgage because the payment remains constant, interest rate remains the same over the entire course of the loan. So that's just a more comfortable situation, and it's now it's much more prevalent as things become more volatile. I'm talking not this week. I'm talking post 2007, 2008, where real estate has gotten a little bit more volatile. Lenders are less apt to advertise um, what would be an adjustable rate mortgage. And these things, you could probably get an adjustable rate mortgage for maybe 2% right now, but it could climb up to 5 or 6 if interest rates went up. And when interest rates now, as we saw, are down around three something, you'd be kind of silly to jump into that to accept that risk for only a point. When we're talking insurance, there's lots of things you can do. Avoiding risks, you can flat not drive a car, not super realistic. Accepting risk, yeah, you can say this might happen, but I'm cognizant of it. I understand what's going on. Insure against risk, and that's really transferring the risk to somebody else, for a payment. But just to ignore it and say, yeah, that won't happen to me, that's not a management method. Anyway. Comprehensive is kind of the catch-all. So you have liability insurance that covers the other guy, the car that you hit. Collision covers your own car when you're at fault. Um, but comprehensive covers that other stuff, wind or hail or other things that typically don't involve. Well, I guess they can involve driving if you think of like a rock flying up and hitting your windshield. That'd be under comprehensive if you're even covered for it, and if the deductible even makes it worth claiming. A deductible, nice segue, not paid by an insurance company. So again, explore this when you're talking to your agent. If you're willing to accept a little bit more risk, say $1,000 deductible, the insurance company knows that you aren't going to be bothering them very often, and they will give you a lower rate if you can handle it. Obviously, with $1,000 deductible, you need to have a bit of an emergency fund to be covering things like that. But that's what I've always done. 37, not covered by a standard homeowner policy. So this would be flood insurance is kind of the answer that they're fishing for here. The insurance is based upon the fact that not everybody's going to crash their car the same day. Not everybody's home is going to burn down the same day, although, some of the wildfires in California have been kind of maybe not great values for insurance companies. But floods, um, definitely have the propensity to take out a lot of different people all at once, all on the same day. And so an insurance company, that's not a sound business model. An insurance company comes in and offers flood insurance. They will collect your money, but when the flood actually happens, they probably would not be able to cover the losses. They'd fold up and they'd either leave you with nothing or you know turn it all over to the government. So anyway, uh, flood insurance is a federal program. That's the only way you can get flood insurance is through by a policy that's you know issued by the issued insured by the federal government. There may be some intermediary. You may be able to get flood insurance through your own insurance company in terms of them managing the policy, but the ultimate insurer is the federal government. And definitely not standard and definitely not cheap. I mean, we're talking, I had flood insurance on my home and they changed the flood zone designation, but it was a $4,000 a year extra expense. And that was, living on not having any insured property on the first floor of the home. So it can get real expensive. So definitely when you're looking for a home, and I've bought in flood zones before because I wanted to live on the beach or I want to live near a river, and that's all good. But just make sure you realize that there's a trade-off there. It's going to be a little bit more expensive if it's in a flood zone. And the mortgage or the bank or FHA or VA or whoever, you may think you own the home, but if they've got the loan on it, they are going to be the ones that insist that you have that flood insurance. So um, anyway, cover valuable property. You need a rider or a floater. There was a question in here. One of the students talked about an umbrella policy. Typically, when we're talking umbrella policy, we're talking about like I've got an umbrella policy for liability. Um, for just would cover everything if somebody came onto the property and tripped on something or whatever. Um, a little slightly different, but a personal article floater or a rider is basically an addendum to your insurance policy to cover some high value items. So again, if you have something, some jewelry, some camera equipment, some guns, something like that, and you think, oh, I'm good, because I've got this general insurance policy, you'll probably find out that no, you're not good because that insurance policy had some limits. And anyway, that could be bad. Might be say $2,000 or $1,000 worth of camera equipment, and you've got tens of thousands perhaps of camera equipment. Yeah, the rest of it's not covered unless you have a specific policy delineating those items. Best way to reduce your homeowner's insurance is to increase the deductible. So homeowner's insurance, car insurance, same sort of thing. Um, yeah. So I would typically on these things I go with a higher deductible, but I try to make sure that I have replacement costs for homeowners items rather than, some sort of depreciated value. Health insurance is expensive, but the good news is most of the time the employer subsidizes part of that cost. So that was the review. We'll leave it there for tonight. Um, Again, if you had any problems with any of the questions on here, shoot me an email. If you make your case, I'll more than likely give you the points back. But that's the main part. If anybody else has any other questions, let me know. Good luck with this whole thing. I mean, we're definitely in uncharted territory. If you happen to have any stocks or investments, 6 months out from now, you are really going to regret selling them. To sell them at the bottom right now would be a very bad idea if you can at all prevent doing that. But this is just sort of a test of patience and everything else. But in the long run, things are going to bounce back substantially. Hopefully, even by the fall. But we'll see. But anyway, it's definitely a trying experience for most people, and good luck.